My name is Jim O'Brien, and I own and operate Wyckoff StockMarketInstitute.com. Welcome to another of our Wyckoff training videos. This one is about an interesting trading range followed by a rather dramatic shakeout. The purpose of these videos is not to present perfect Wyckoff depictions of individual stocks. Unfortunately, the world, and most importantly, the stock market, simply doesn't work that way. However, if we do our Wyckoff analysis and create different scenarios for what might happen next, and stay true to our Wyckoff strategies and techniques, we will end up with more than our share of successful trades. McDonald's Corporation, MCD, is a great example of how things began in a slightly different manner, but the patient Wyckoff trader would have ended up with a nice profit.
In May 2014, McDonald's began a reaction that took it down to point A on the vertical line chart. The beginning of this reaction is not shown on the chart, but the intermediate term downtrend channel is shown in red. The reaction was completed at point A, which was a possible selling climax. This suggested that McDonald's might begin to move sideways in a trading range to establish a foundation for its next move. However, the intermediate term downtrend channel was still in effect, and the Wyckoff student could not begin to think about accumulation until that trend was broken. If, after the automatic rally to point B, the Wyckoff Wave reacted strongly through point A, that would indicate the reaction would continue and point A was not a selling climax. The first signal that a trading range was developing would be the breaking of the intermediate term downtrend channel. McDonald's rallied to point B and then reacted to point C. While this reaction held slightly above point A, volume was relatively high. This suggested the continued presence of supply. More importantly, the downtrend channel was still in effect. For now, McDonald's remained in a watch and wait category. Things look a little better as McDonald's rallied nicely to point D and then reacted to point E. Notice the reaction was on slightly lower volume and noticeably reduced price spread. More importantly, McDonald's was unable to return to its intermediate term downtrend channel. On the reaction to point E, the downtrend was broken and a new neutral trend was established. It is reasonable to conclude that McDonald's is in the trading range that began at point A. However, there has been no ending action, and the Wyckoff student needs to continue to watch the stock's performance, wait for ending action, and then look for a place to take a position. In most cases, this would be a spring. Then something unusual happened. Without going through a spring, McDonald's rallied strongly to point F. This took it through the top of the original trading range marked by resistance at points B and D. This was a potential sign of strength through the top of the trading range. This is also called a jump across the creek. While not common, it is quite possible for a stock to have a sign of strength without going through a spring. However, when something like this happens, a few different scenarios need to be considered. Every time a stock jumps the creek, one of three things can happen, and each one of these must be considered in every single instance. First, the stock should react back to test the top of the trading range. If the reaction is on reduced price spread and volume, and the stock holds at or above the resistance, this can be a last point of support. Secondly, the stock could also encounter supply and simply react back into the trading range. This would mean the stock is not ready to make its next move, and the trading range will continue. Finally, the stock could simply hold above the top of the original trading range but not resume its rally. Instead, it would begin to move sideways. This creates a new phase of the continuing trading range. It also eliminates the move from point E to F as a sign of strength. Which one of these will happen? Well, let's look at the reaction to point G. The price spread is somewhat wider, but more importantly, notice the relatively high volume. While the reaction did end in the area of point D, and the technometer was in a slightly oversold condition, the presence of volume still suggests that supply is present, and it did not totally dry up, in the manner one would expect on a reaction to a last point of support. While a position to the upside could be taken at point G, it should be watched closely. The presence of supply could be a signal that McDonald's may not be ready to make the expected strong move to the upside. While McDonald's did rally off point G, it quickly ran into trouble and encountered resistance at point G1. At point G1, McDonald's is in a position where demand needed to come into the market and the stock had to go and go now. Instead, McDonald's reacted on a lack of demand. This strongly suggested the new trading range scenario described above was taking over and the stock would continue to move sideways until there was ending action. Any positions taken at point G should have been closed in the area of G1, as the stock was not able to move into new high ground. Then, McDonald's moved sideways in a relatively narrow trading range for about 5 months. It did attempt to leave the trading range to the upside at point H. While the stock approached the top of the new phase of the trading range on wide spread and strong volume, there was no follow-through. Even though supply came into the stock at point H, the stock's behavior was not consistent with an upthrust. It was just another resistance point on this long sideways move. Finally, McDonald's rallied to point J. Notice the rally was on relatively low price spread and volume. At point J, it meant supply and reacted sharply. Notice the wider price spread and increased volume. This is a change in character and suggests something is about to happen. That something was a shakeout or a number one spring. McDonald's not only reacted through the support formed by the new phase of the trading range, but also moved below the initial support line of the first phase of the trading range created from points A and C. While there was a wide price spread and high volume, once McDonald's penetrated the support at point K, strong demand came into the market and the stock rallied sharply to point L. Shakeouts must be tested. The test came at point M. The reaction to point M was on lower price spread and lower volume than the reaction to point K. In addition, the technometer was in an oversold condition. This confirmed a secondary test and made point M an excellent place to take a new position to the upside. Remember, secondary tests happen quickly, so the Wyckoff trader needs to be nimble to catch the best entry point. There was an initial count of 23 points on phase 1 of McDonald's 1-point figure chart. That indicated that the first objective was between $116 and $122 per share. McDonald's rallied to point N and then put in another relatively long and slow reaction to point O. The reaction held above the support line of the new trading range phase and suggested supply was drying up. In addition, the technometer was, once again, in an oversold condition. This offered another opportunity to either take a new position or add to an existing one. It also allowed for the drawing of a new upward trend channel with support points at points K and O. A parallel supply line can be drawn from point N. While an initial upward trend channel could have been drawn through points K and M with a parallel supply line from point L, this was quickly broken, and the reaction to point O offered an opportunity to better define the new upward trend. McDonald's rallied to $120.25 at point R. Notice that at point R, the stock was unable to reach the supply line of its upward trend channel. While the first objective was met, it appeared demand was being withdrawn and the upward momentum was beginning to fade. This would have been a good place to close positions and take profits. McDonald's reacted to point S and noticeably weakened its upward trend channel. It barely returned to the trend channel on the rally to point P and broke the demand channel on the reaction to point U. While McDonald's eventually rallied to point V, which met the Phase 2 objective, the move lasted for 3 months. That's a long time for an additional 5 points. Every Wyckoff trader should have a few stocks like McDonald's that are in a developing trading range. While some may end up doing nothing, others, like this example, rewarded the patient and observant investor with some nice profits. You can learn more about these profit-making strategies, including examples of relative strength and weakness, trends, trading range phases, the opening and closing of positions, and many more, by reading our Wyckoff ebook called Wyckoff Strategies and Techniques. The book is an updated version of the Wyckoff course in Stock Market Science and Technique. As a special bonus, a free audio recording of the ebook is included with every purchase. The audio recording has its own set of charts that make it easy to follow along as you learn more about the Wyckoff strategies and techniques. Learn more about how to make better, more profitable trades by using these time-proven Wyckoff strategies and techniques by simply clicking the link below.